All right, Investment Companies, Chapter 7, Investment Company Act 1940. Investment Company Act 1940 defines the investment company to deal with a corporation or trust through which investors pool their funds in order to obtain diversification and supervision of their investments. Management company directs the investment mix of the portfolio. Decision professional services are not available to individual small investors but can be obtained by a method of investing. Management company charges a fee of approximately 1.5% to 1% of the asset of the service within recent years. The level has come closer to the lower end of the range. Management contract must be renewed by shareholders' investment company each year. No long-term contracts are permitted under the law. There are three classification of investment companies under the 1940 Act. Face amount certificate companies. The issue of the face amount certificates was purchased by an investor via with a single payment through the series of installment of face value with the certificate is paid at the end of a particular time period. Interest paid during the life of the certificate guaranteed by the investment company. The guarantee is often backed by real estate or some other asset. Unit investment tax trusts. Unit investment trust, These issues redeem units. Each unit represents the specific interest in the portfolio security. Some of the trust person purchases share of a particular investment company. Investors then purchase shares of the trust under the contractual plan. Most contractual plans use a unit investment trust vehicle. Management companies. The managing of the diversified portfolio security seeks an attainment of specified investment objective. The management company may either open or close end. Within the open-end management type investment company is known as a mutual fund. Real estate investment trust. Real estate investment trusts were established to supply capital to the real estate industry by providing money with a mortgage, construction, and other similar enterprises. They are comparable in many ways to a closed-ended investment. The real estate investment trusts are required to distribute a minimum of 90% of their net investment income to the beneficial owners of the shareholders. Capital gains may be retained by the real estate investment trust, distributed to the owners in the trust desires. Additional real estate investment trust certificate concentrates the investment of the real estate-related ventures. At least 75% of the asset must be invested in a manner. Open-ended versus closed-ended investment company. Three basic differences between open-ended and closed-ended investment company. Capitalization. Open-ended with investment company, the unusual form of security with a continuous offering of the new shares. When an open-ended company is started, the new issues offered for the public. However, unlike their other new issues, this one does not. The fund continues off share, but there is no limit to the amount that can be offered. The public offering price is determined by a formula described by the prospectus. The prospectus must be reissued at least every 16 months. Closed-ended investment companies have a fixed number of shares, but these shares are traded on the stock exchange over-the-counter market. Some well known as closed-ended companies are PINCO funds in Alliance, New York. Determining the marketplace. Determining the market price. The market price of the open-ended company makes up the net asset value of the share one each business day of the fund, determined with the net asset value per share. They make with a calculation more than once a day for the marketing purpose. If they wish, the value of the portfolio holding, determining total assets, liabilities, then subtracted, having total net asset of the total is then divided by the number of shares outstanding for the moment, yielding that asset value per share. Let's suppose with the calculator show the per share net asset value of $27.60. This would be the bid side of the quotation. To be obtain the offering price, we would factor in the sale of the charge of the load, which can be as much as 8.5% of the offering price and 9% on contractual plans. Some funds have no sales charge called no loaded funds, where in this case the bid and offering price would be the same figure. The quotation would be $27.60 at $27.60. Let's suppose the maximum sales charge at 8% of the maximum sales charge is always used in calculation volume. Discount rates are not considered. Keep in mind that the stated sales charge and percentage of the offering price, not the asset of the value. With given the asset value at $27.60, the minimum sales charge at 8%, we simply take the difference between the sales charge and 100% to divide the figure in the net value per share. 1% minus 8% maximum sales charge, 92%. At $27.60 divided by 92 is $30 offering price. Our quotation therefore is $27.60 to 30. Let's check to see if the calculation is correct. We've stated the sales charge at 8% of the offering price, $30 at 8%, and $2.40. Difference between the bid at $27.60 of the offering at $30 is $200.40, which appear with the be correct. The quotation remain until the next computation day later. All orders mutual fund shares must be executed with the next price after the order is entered for the fund set price at 4 p.m. each day with the offer received up to the time executed at the price. Those received after 4 p.m. must wait with the next day's price. This is known as forward pricing, which institutes some years to eliminate abuse of the old method and permitted the order to be executed based on the prior order than being entered. Market price shares are closed-ended investment. Companies are determined with the supply and demand. They may sell asset values above asset value, below asset value, depending on the condition of the market price. Redemption. Opening end of the investment company shares are redeemed by selling shares back to the fund, but normally at an asset value. In order for ordered have been entered as sell shares in the next established quotation in 2016 and 330. The shares would be redeemed and funded at asset value 27 and 60. Occasionally there's a small redemption charge, but there's no prevalent in the recent years. In general, the investment company must redeem shares within 7 days after the holder submits a request to redeem. Closed-end shares are sold in the open market. Again, the price is determined by supply and demand and may not necessarily be related directly to the net asset value. Diversified by non-diversified companies. Management type of investment companies may either be the diversified and non-diversified. The diversified company must adhere with a certain investment stream with 75% of the assets must be invested in such a way that no more than 5% of the total asset invested with securities in any one of the company. The investment company cannot purchase more than 10% of the voting stock of the one corporation. For example, the investment company total assessment of $100 million must invest $75 million of the asset, 75% of the asset, so that no more than $5 million are invested in the securities at one company. Additional investment made in the representative of the ownership of more than 10% of the voting stock of any corporation. These standards assure the diversification risk of the investment and prevent investment companies from taking control of the position of the public corporations. Type of investment company. The objective of the Investment Company Act of 1940 requires the investment company to state with their investment objective policy with the prospective of any change of the policy must be approved by a majority of the funds of shareholder. Here are some of the different type of the funds based on the objective. The common stock funds. Funds invest most of the assets of the common stock of the generally grouped into maybe many varieties. Some of the stress investment with some of the stress investments is in growth companies, while the other concentrate in high-grade common stocks, often referred to as blue chips. Some common stock funds steer the intention into select more speculative stocks for better than average growth potential. These, of course, carry a high degree of risk. Bonds and preferred stock, they have been a greater factor in recent years to increase the interest rate pending the investment fixed income securities provide greater than the usual current return to the holder. Balanced fund, these funds vary investment among common stock and preferred stocks and bonds. They're said to be most conservative type of the funds. They can shift the holdings depending on the market condition. Often the balanced funds will stay with the prospectus when a portion of the portfolio may be invested in each type of the security. For example, the 40% common stock, 20% preferred, 40 cents in bond. Government funds, their funds with the investment objective of the capital appreciation investment security that they believe is above the average growth potential security usually have the higher market risk. The older the destroy, the greater the risk, the greater the reward. Government bonds, the funds only invest for the treasury securities. Municipal bonds, these funds only invest in municipal securities. And in fact, the municipal bonds fund only invest particular state securities such as New York, Florida, give the residents of those state complete tax-free income. Index fund. The invest in security that match with those of the particular index is Standard or Poor. Investors feel that the investment will also at least keep up with the market. International fund. The funds invest for the foreign securities, making it easy for the Americans to invest overseas. Maybe they speculate particular countries such as Japan, Korea fund. Another type of the international fund with emerging market fund, the funds invest in the security of so-called third world countries. Exchange trade funds. Similar to the mutual fund with investor pools funds of the aim of the professional management of diversification. However, these funds are not purchase redeemed, but they issue with a purchase on various exchanges of the NASDAQ. Many of these funds are compromised various indexes indication of the security that may be purchased on margin, a limited stop and market order may be utilized with the purchase and scale, but they have become extremely popular in the recent years. Income fund, the attempt to provide greater than usual income, while these funds often invest in good quality bonds, they may provide great return by purchasing bonds of low quality. While these are so-called junk bonds can provide higher return, they also entail greater usual risk. Special funds, the funds concentrated in investment in a particular industry with a group of related industry. Perhaps they will invest in the chemical, drugs, stock, public utilities, airlines. Some of them even specialize in investing in a particular geographical area, such as the southwestern United States, feeling that it may experience economic growth suppressing other parts of the country. Dual purpose bond. These came in existence in 1960. The closed-ended companies that offer two classes of stock, generally income shares and capital share. Of the two classes are issued with equal amounts. Holders in income shares receive all the income generated by the entire portfolio, while holders in the capital should receive all the capital gains gained by the entire portfolio. This type of the fund is called leverage. A shareholder receives $2 benefit for every $1 invested. Money market funds. These funds become very popular with the interest rate with the rising tripling in the 1970s. The funds shall invest short-term money market securities, generally U.S. Treasury securities and bank certificates of deposit. Shareholders of the funds receive the current short-term rates and have a very low risk investment. Many of the money market funds provide other services such as check writing privileges. Distribution of open-ended investment company shares. As we've noted earlier, closed-ended investment company shares are bought and sold on the open market with the price determined by the supply and the demand. Open-ended company shares of the mutual funds are distribution using 4 different methods. Fund and underwriting selling group member investor. The most usual method utilizing the underwriting selling group is much of the offerings of the new securities. The open-ended investment companies, however, the offering will continue. The investor with wishing to purchase the ABC fund would be placed in order, and security dealers would sign with the sealing of the agreement with the fund. The dealer would place the order with a fund underwriter who would purchase the shares from the fund, and at the next pricing, underwriter would purchase the shares at the offering price at less than total sales charge. Underwriter would then sell to the selling group, the dealer, at the offering price of the less portion of the sales charge. Selling group then sells the client at public offering price. Let's say ABC Fund has an asset of $27.60, minimum sales charge of 8%. Offering price would therefore be $30. $27.60 divided by 92. The customer orders executed as follows. ABC Fund underwrites $27.60, $30 minus 8%. Underwriter selling group member at $27.90, $30 minus 7%. Selling group member into the client, $30 offering price. No, but the fund received $27.60 asset value. Each share is issued with the experience of no dilution. Underwriter keeps 1% of the 8 sales of the 8% sales charge for his efforts with the selling of the group members, earning the other 7% of the client's paying offering price of $30 per share stated in the prospectus. Other figures illustrate purpose only for the in line with those generally used in the industry. Fund underwriter investors. Such funds underwriters employ with their own sales force do not employ the dealer selling group. In this case, the distribution would, and fund underwriter investor. Fund investor. Many funds with no sales shares are bought and sold in net asset value. In this case, the investor buys directly from the fund as no load, sales charge, no underwriting. Selling group is used. They often referred to as low load funds. Fund underwriter plan company investor. Mutual funds are often offered a periodic payment contractual plan. These are usually offered to the dealer known as plan companies. In these cases, the fund sells a share with the underwriter who in turn sells with the plan company. The company distributes for the investor under the term of the contract. Note that in the contractual plan with a maximum sales charge that may be charged is 9%. Restriction distribution investment companies. The regulatory authorities require that the distributor of the investment company share that comply with the regulations not required for the distribution of the other products. They feel that the purchasers of these shares, often small investors, are not sophisticated investment and techniques. They therefore require more than usual protection. Some of the special restrictions are no special deals can be offered by an underwriter mutual fund shares. For example, the underwriter cannot contract with security dealers. Often offer gifts and prizes such as a vacation trip with the salesperson while meeting among the shares of the client. The special incentive that might cause some of the ethical salespeople to then do for the clients to the purchase of product not suitable for the investment purpose. Such underwriters wish to host a luncheon cocktail party to explain the operation firm sales force. This would not be a violation of special deal prohibition. Broker dealers may not trade open-ended investment company share. This is that and maybe not buy with a firm inventory hopes of the selling at a higher price at a later date. Fear is that of the unscrupulous dealer may attempt to force the shares on some of the clients who should not own them. Therefore, broker and dealer may not take down shares of mutual fund from underwriters except with the fill order previously received by the firm's own investment account. With the rules applicable to trading mutual funds is quite using with the investment business. Dealers buy stocks bonds with inventory with the anticipation of rising market. Dealers mutual funds are required to maintain public offering price with the competition called for the price cutting with the security dealers. The practice of could not be applied with the sellers opening the share. For example, the selling group would earn 70% of the charging selling of the funds for the purchase at $30 less than 7% and sells them to investor at 30. He might be willing to offer 2% discount with the clients in order to develop sales as well, but still leave with a 5% profit. However, while this is done on the sales of the other products, it cannot be done with fund shares. The dealer must maintain public offering at the price of the front end and load shares that are referred to as Class A. Contingent Deferred Sales Charge, or CDSS, commonly referred to as bank-ended loads, permit investors to buy a share of the NAV. However, the sales charge imposed at the time of redemption of the shares under the normal circumstances. Sales charge reduced for the longer will hold the shares. If you hold them long enough, the sales charge is eliminated. Hence, the name Contingent Deferred Sales Charge. These shares are referred to as Class B shares. Class C shares, these are shares so-called the 12B1 annual fee, referred to as level load, which is currently equal to 1% of the fund assets. In addition, not all but some fund charge in front and sales charge of 1%. Further, some of the funds impose a contingent deferred sales charge if the shares are sold before 18 months have passed. Method of purchasing open-ended investment company share of the regular account. With a regular account, with the client purchase shares of the wood purchase for the shares of the security, he simply places an order and specifies the number of shares and makes the payment in the normal manner of the shares of them, either be sent with him with the help of his account. Although this is usual manner which other securities that are purchased with the most unusual mutual fund, the purchaser product, but generally attempting to buy the investment to attain the sum of the future goal of the 10 to accumulation type. Account letter of intent. Letter of intent with the customer states that he plans to purchase shares over the period of time without taking advantage of the break points and the sales charge usually referred for. With the example that our fund must apply 8% load of the amounts of the under $100,000, but the charge might be only 70% of the amounts of $10,000 to $20,000 and $20,000. The charge will continue to decline at the point of investment of $1 million or more. The charge might drop to 1%. These levels at which the charge produced are called breakpoints, at which we say the purchase from mutual funds are usually small investors seldom with large amounts of the dollars to invest one time. They might consider signing a letter of intent, which total amount invested over the period to exceed 13 months would be considered. When determining sales charge of this investor of the $1,000 per month at 12 13 months should be charged 7% rather than 8% of the retroactive basis. Letters of intent are also backdated up to 90 days for the taking advantage of the deposits made prior to the signing of the letter of intent available to individuals or to the groups of the related to such pension profit share plan, but not available to groups of unrelated people such as investment clubs. Distant relative letter of intent is called the right of accumulation. Here, the total value of the client invests and consider the determine the sale charge of the small investor reaches the $10,000 break point after 70 years investing. The fund share from the point of the sale charge could be reduced 7% rather than 8%, while the reduction is retroactive. It could provide savings in the future. Voluntary accumulation plan. A voluntary accumulation plan is best described by the word voluntary title. In this plan, the client makes the initial purchase of the minimum amount with the usually required makes the subsequent deposit against usually minimum requirement on the volunteer basis. Thus, the client must start with a plan with a deposit of $250. Make subsequent deposits of $50 or more whenever the funds are available. Frequently, the client reinvests the income capital with the gain distribution of the net asset value saving sales charge. Please note that although through the client may elect to reinvest the distribution, that would be nothing less of a taxable to him. With that year, the client using volunteer plan will reap the benefits of professional management of the portfolio, hopefully building the investment value of the funds employed with the bank trust company, act as a fund custodian. Among the duties of the custodian are function either the registered transfer agent, fund share, of the acting of the dividend disbursing agent, receiving the investment payments for the client, maintaining custody of securities owned by the fund, bookkeeping and record keeping, the dollar costing and averaging, investing technology, dollar cost averaging, called with a periodic investment equal to dollars amount security of the investment company if the plan properly fell. The result of the inventory result in investors obtaining an average of the shares and lower average price paid. For example, the person invests $200 per month in an investment company for consecutive months as follows. After 4 months, the total $800. The share price was $21, and the number of shares purchased were 165. The investor purchased 165 of the total shares at 800. Therefore, the average cost per share was $4.85. 800 divided by 165. However, the average price paid per share, for the share was $5.25, with sum of the price of 21 divided by the number of the purchase at 4. There's no way that the guaranteed profit that shares will be trading below or the client cost of 5.25 by keeping the dollar amount of the investment consists of the investor buys the most share of the price at low as 50 shares of it at 200 at the price of $4. Fewer shares at higher price, only 25 shares for $200 when the price is $8. Regulation governing the sale of the investment company securities. Securities Act 1933. Securities Act 1933, Governor offering the new issue, the Secretary of the Related with the Matters Investment Companies must file with the registration statement of the Secretary of the Exchange Commission prior to the original offering of the shares. Full disclosure of all of the material information required with the registration statement of the Securities Exchange Commission does not prove the issue, but only attempts the information most available to prospective investors. Alright, as with other new issue, the fund must publish the prospect must be provided with an investor prior to the release for the solicitation of an order. Some of the items required for the prospect with the type of the company, open and closed end, etc. Investment object for the investment policy, management fees, sale charges, redemption features, Investment Companies Act of 1940 and the 1970 amendments with the discuss the parts of the law with on our party and study of the investment company, some of the additional provisions studying topic should know. Follow. In order to make public offering in a share, the registered investment company must have a net worth of at least $100,000 or more than 50% of the director's investment company may be affiliated with the investment company underwriting investment advisors. Registered investment companies may not purchase security margin. They may be under certain conditions make short sales, however, which may with the margin account. Dividend paid with the shareholder that must be paid with the fund in that common amount for the receipt of the dividend, instead of the interest of the bond. Maximum sales charge for the contractual plans may not exceed 9%. Open-ended companies may issue only one security, which must be voting stock, but they may not issue senior securities such as bond or preferred stock. With the prohibition does not apply to closed-end companies. Fund may not purchase securities companies with the fund office of the directors over more than 5% of the company's security with the collective funds. Officers, directors, or more than 5% of the company's securities. The majority of shareholders must approve any major change in fund policies. Internal Revenue Code Subchapter M. Investment company registered under 1940 qualify with a regulated investment company under the Internal Revenue Code Subchapter M, and the registered regulated company will receive the problem of double taxation and capital gains. Income and capital gains will be distributed to the shareholder but not taxable to the investment company. With the conduit and a pipeline theory of the taxation allows the fund to avoid much of the direct taxation with inhibited investment program. Qualify for the favored tax treatment. The investment company must meet the certain requirements. One investment company must be the domestic concern, and it must be registered the management company unit investment of trust under the Investment Company Act of 1943. A minimum of 90% of the gross income annually must be received from interest on the bonds and dividends on the stock of the fund's portfolios. 4. Fund must distribute a minimum of 90% of the net income and the interest of the dividends to the shareholders. And most of the company distribute all investment income, and as the shareholders generally reinvest their monies, they leave the fund free from any of the tax liability. Company capital gains are not considered to be investment income. An investment company can distribute the share of the one whole or part as they see fit, but the capital gains are distributed taxable to the shareholder. They are retained from the taxable to the fund. No requirement to distribute the capital gains under the Internal Revenue Code as there was an investment company holding period for the determine the capital gain. The distribution is treated with a short-term, long-term gain by recipient shareholder. This one had a securely long enough qualified long-term tax current treatment, currently more than 1 year and sold. The security is a profit. The distribution profit the shareholder would qualify as long-term gain. The shareholder possible for the individual to hold the fund share over the short period still receive the capital gain distribution. Capital gain distributions are made no more than once each year, but they must be made with the year taken. The distribution investment income, however, they usually made a quarter by the investment companies to their shareholders. Alright, great care must be taken in expressing yield of the rate of return investment company share of not deceive the potential investor yield only can be expressed with a 12-month basis. Improve the tally over the client. The fund yield is 7% over the last 6 months, applying 14% annual return, which may not be the case. Further yield may express them only in one of two ways: current yield with a historic average yield. Current yield is determined by using the current offering price and adding it to the capital gain distribution made over the most recent 12 months. The additional reflects of the head of the fund does not made the distribution offering price somewhat higher by the amount the new offering price has divided in total income. All income distributions made during the last 12 months. The result is current yield. Historic average yield is determined by using average month offering price over the past 12 months. This figure is divided into income distributions for the period, resulting in historical yield. Capital gain distribution is not considered in this calculation because using average monthly offering price of the distribution have been factored in. Exchange trust traded funds. First exchange traded funds that came into being in 1993, the SPDR 500 Trust was traded with the American Stock Exchange. That began the common investment vehicle for both individual and institutional investors. Is writing that there are hundreds of U.S. exchange-traded funds which assess excess of $200 billion. Exchange-traded funds are similar to open-ended mutual funds as well. They represent with a fractional ownership of the underlying portfolio. Securities trade with a specific market index. However, the exchange-traded funds are traded at American Stock Exchange, Chicago Board Option Exchange, New York Stock Exchange mutual funds. On the other hand, a purchase redeemed directly with the fund itself. Consequently, mutual funds cannot be purchased with a margin since they are classified as a new issue. Mutual funds may be carried on a margin for 30 days after the purchase. Since the exchange trade funds are listed securities, they may be purchased in a margin account. Another difference of the mutual funds are priced from the one to the day of closing in the market, and price of the exchange-traded funds fluctuate according to the change of the underlying portfolios, according to the change of market supply and demand. The normal statement is the exchange-traded funds are just like closed-ended funds. However, unlike closed-ended funds, exchange-traded funds are permitted to continuously offer shares which change the numerous outstanding shares of which, in fact, change with the daily and to meet the demand. Consequently, there are no discount premiums for the net asset values or NAV, commonly closed or usually with a discount. The net asset value, sometimes premium to their net asset value. Some of the popular exchange trade funds have the NASDAQ 100, Share Russell 3000, Share Russell IWM, iShare S&P 500, SPOR. Following brief decision carries exchange-traded funds. Continuous pricing. Exchange-traded funds have similar intraday pricing as other securities. The estimated non-assessed asset value, called the indicative optimized portfolio value for the basket securities, the replay price of the market markers specialties every 15 seconds, and is the process of the key premiums, discount, and net asset values at a minimum. Diversification, much like mutual funds, exchange-traded funds eliminate single stock risk that occurs when the investor invests primarily in the favorite stock sector. Fee for the exchange-traded funds, subject project, broker commission. However, the savings is lower. Annual fees affect the cost of long-term holders. Annual fees for the exchange-traded funds are lower than most mutual funds. Settlement trade settles in 3 business days. All shares are booked and are entered into a depository trust company. Trading unit around lot is 100 shares. Oblot is less than 100 shares as well. Alright, prohibited practices selling dividends as in due for the customer purchase share price for the imminent dividend. For example, opening an investment company was quoted 9.2 and 10. Fund has announced the dividend of 50 cents if it would be paid with the near future. If salesperson attempted to induce the client to buy a share of saying, hurry up and place your order. You will receive the 50-cent dividend on a $10 purchase price. That's 5% of your money. In fact, the investor would gain nothing since the share traded at X dividend price would decline at 50 cents. The investor waits. He will buy a share of the lower price will now incur the tax liability for the dividend. To prevent selling dividends, investment companies often use special date declared by the directors as X dividend date rather than the general use X date in the industry, with 2 business days prior to the recorded date and investment prior to large distribution cause tax liability. Twisting is causing the investor to sell one investment company to purchase another similar company solely to create new sales charge for the benefit of registered representative in other areas of other business. We call this improper treatment of customers churning, by which investment companies are turning. In investment term twisting, as you've noted, would be not twisting a switch from one investment company to another is suited to the needs of the client. For example, change of the growth fund to an income fund for a recently retired person might represent some sound investment advice. Alright, breakpoint. A breakpoint is a device used that causes the client to pay sales charge larger than might have been necessary. A particular investment company has a scheduled charge that calls the 8% load for investment less than 10,000, but 7% investment for 10,000 to 20,000. So the person recommends a purchase of $9,900 of the fund of the client should have the might be obtained with the highest sales charge. This is a flagrant breaking point. Sale valiant since investing an additional $100 the client would save the $100 in sale charge. Violation could be subtle with such breaking any investment similar type of the company's when the client could achieve the saving costs and placing his dollar in single investment. Advertising sales literature, Securities Exchange Commission Rule 158 replaces statement of policy of sales literature. Investment companies does not specify the exact requirements is aimed to provide guidance for the preparation of investment company advertisement. The term sales literature includes all communication, whether writing or otherwise, used by a person to offer, sell, that induce a sale with an security and with an investment company. The use of sales literature connection with a sales investment company is unlawful for the information materially misleading, contains untrue statement of material fact, omits a material fact. In fact, information may be considered the misleading and lack of proper explanation, qualification, limitation present of the past performance ways and implies similar future performance misrepresent the investment company and or its management. Sales literature is covered whether it is be used on the issuer, underwriter, dealer, registered representative. It can be reasonably expected to be used with the perspective of its clients. Sales literature may not be imply that the credit person's investment will in truth be preserved or be protected against loss. A discussion of the advantage of the investment must be balanced on the discussion risk. Alright, fixed and variable annuities. To make proper study of the variable annuities, first look at the annuity contract overall production. For many years, the insurance of the industry of the United States have offered fixed annuity contract policies designed to supplement other forms of insurance, which began to pay only on the death of the insured person. The fixed annuity, on the other hand, allows the payment of the fixed dollar amount periodically to the annuity during life, provide a source of the retirement income that would be to supplement other than benefit the company retirement. Social Security fixed annuity would begin to be paid certain time per half of the annuity reached at age 65. There is a minimum age of 59 and a half to avoid penalties. It would pay a fixed amount, about $200 per month, a fixed period. You may usually the life of the annuity of the contract was set up to pay with a joint supervisory provision. In this case, the payment will continue to pay after the death of the survivor, usually spouse for the remainder of the person's life. Fixed annuity can be purchased in single lump sum of the payment of the periodic premiums over the period of years. Mortality risk. Insurance companies pay for their payment a guarantee for the continuing study of the expectancy with the payment of fixed annuity. Calculated finding an annuity will go this reward. He'll hit to his reward of the fixed date. Should the insured person outlive the expectancy of the insurance company, may continue to make the agreed payment. The mortality risk is borne by insurance company, but not a purchase of fixed annuity contract. Investment risk. Investment risk fixed annuity contract also born insured with the day of the earlier the annuity it may live beyond the expectancy causing payment to the contact. Continue past the anticipated lifetime. Additional insurance company investment experience may not as be as favorable as expected. Company invests in reserve security and mortgages in return for the investment. Decline for the still obliged to make the agreed payments. However, the income of the investment greater than the anticipated expense paid for the annuity naturally carefully study with the given investment program fixed annuity payment agreed to with a conservative exemption. However, the investment risk of the fixed annuity contract belongs to the investment insurance company. Variable annuity contracts generally allow for the unused units based on the beneficiary cost of the annuity dies before the receipt of the payment of the entire holding called by the insurance people. The adverse mortality experience with the descendant spouse might receive the payment of remaining units and might become an asset of the descendant sale. Should the annuity live beyond the expected time, it would exhaust 12,000 units. However, they would continue to be paid at 150 units each month of its life. The mortality risk, therefore, borne by variable annuity company. Assumed investment return, or AIR. Determine initial movement monthly payments are variable to annuities. Calculation consider the amount invested with the contract, while the assumed investment return is also recognized. The additional amount is usually figured at 5% per year, but including calculation, annuity may receive the monthly payment of $8 for each $1,000 invested at age 65. Without a assumed investment return factor, the rate might be $6 per 1,000, making contract unattractive. By using the assumed investment return, we assume that 5% of the annual growth rate will be occurred should the return period greater than the assumed investment return. The other value of the annuity unit will increase the will payment of the contract holder should the assumed investment return not be achieved. Both the unit value and payout will decrease. Assumed investment return is not a guarantee as possible. The anticipated rate will not occur. However, the assumed investment return, generally conservative, an equity company expects to meet its goals, therefore includes its calculations. All right, Chapter 8, Federal Reserve and Margin.